And welcome to the VSA Capital Tech and Transitional Energy Podcast. It's Thursday, the 26th of January. Phil, how you doing?
Very well, thank you very much, Andrew.
Good. Now, we're obviously very busy, so we're going to try and keep this one as short as possible because I'm running around at the moment with Invinity Energy Systems on a non-deal roadshow. But actually, just before I get there, I mean, a couple of points about the market and also about renewable energy, actually. We are currently in the green wars, as they're calling it, where the EU and Europe is complaining that the US is unfairly subsidizing renewable energy companies and battery manufacturers to gain an advantage. Well, to me, that sort of makes political sense, actually. So it's not really unfair. It's just sensible. But then you've got also these US senators from states coming over here saying, look, if you move your business from Europe to America, we'll give you a subsidy. Well, that's pretty attractive for those companies. And again, I think that's America being clever. But anyway, Europe's not happy about it. We're in green wars, but it's all good news. It does mean that, there's going to be a lot of attention onto renewable energy companies again. Now, I did notice also, Phil, I think you saw that Grant Shapps yesterday, our one of our wonderful idiot politicians, was saying we don't have to worry about the green wars because we're 10 years ahead of the US. What absolute, utter rubbish. The UK is about 10 years behind the US. Take my word, I go out there pretty regularly and I know it. Grant Shapps is a complete and utter idiot. I can tell you, he actually only got 5 O-levels at school and he started his life as a photocopier salesman. That's the sort of politician we have, Phil, in this country.
Oh my God, poor old Grant Shapps. But I think you may have a point about the US being well ahead of the UK on renewables. That's for sure.
Anyway, there we go. Now, look, actually, I'll be absolutely honest with you, Phil. I'm not sitting here alone talking of the US. I have actually got with me the chief executive of Invinity Energy Systems, Larry Zulch. Larry, hi, how are you?
I'm doing well. Thanks for having me, Andrew.
You've just popped in between sort of things. We've got sort of 5-10 minutes to have a little chit chat about Invinity because it does feel, as I just said then, the green wars have started up. We all know that long duration energy storage, it's going to happen. It's got to happen. But one of the things, obviously, we've talked about Invinity a lot on this podcast. One of the things that you're saying as we go around seeing the institutions, and I know they're getting pretty excited about this, is that if you look at the levelized cost of storage, known as LCOS, actually what you're saying is you are now getting to a point, because your system lasts for 25 years, where not only are you getting to a price point which is better than lithium, but you're also getting to a price point that's better than fossil fuels. And when that happens, the whole thing just goes ballistic. And I mean, it's going to be incredible. I mean, talk us through that a little bit, Larry.
We call it the renewable energy singularity, really. I mean, it's not just us. If you look at solar, it didn't take off until solar got less expensive than other ways of producing energy. Well, now you have solar that is very inexpensive, but you're at the mercy of the sun, and with wind power at the mercy of the wind. So to make it competitive with fossil fuels, it has to be dispatchable. Now, the best of the fossil fuel price per megawatt hour is a combined cycle gas plant, about $80 a megawatt hour of levelized cost of storage. Solar, wind, they're down in the $20 neighborhood, 20, 25. You have to add storage to that. If you can be under $80, then you're going to be buying a renewable energy power plant in preference to a fossil fuel one, not because you care about reducing carbon, but because it makes economic sense. Well, right now, that's not the case. The battery storage, the best cost is probably ours, flow batteries, vanadium flow batteries, and even then, we're closer to 100 than 50. Next generation, though, will be 50. And we'll be hitting the targets that the U.S. Department of Energy has set as their moonshot goal. They know the importance of getting levelized cost of storage down. They set a goal for 2030 of $50. We're going to be there by 2026.
Which is just absolutely critical, because we don't have to worry about the politicians anymore. People will just buy it because it's the cheapest. Now, just Larry, you heard my little introduction there. Quite interested in your thoughts on the introduction, not on Grant Shapps. I'm not asking you on that, but on the green wars, because obviously Invinity is it's got a foot in both camps, which is actually quite clever. Hopefully, you're obviously from San Francisco yourself. You're an American, but do you see the green wars? And I mean, what are what are the sort of things you're being offered in America that are going to be really rather attractive to you?
Well, every state has incentive programs for people to put their factories in that state. And then the federal government's doing the same thing. And then there's also the other side, and that is the supply chain and a real interest in having Build America to get some of the incentives that the federal government is putting in for projects. So you add all those together, and it becomes pretty compelling to have a footprint in a very large market.
And this is a sort of speculative question, but are you going to end up having a massive manufacturing capability, you think, in America at some stage?
Well, the projects that are funded in part by the Inflation Reduction Act, the IRA, must have domestic production in order to qualify. And that domestic production is a percentage that's coming from the US, and that increases over time. We intend to take advantage of that funding. So I think the answer would have to be yes.
Okay. And so another question, we've during this trip of yours, we've actually met with a major global customer. I mean, one of the biggest in the world. I mean, he said the problem that we've got and you've got actually is not demand, but is the ability to supply that demand. Because he was talking about, you talk still about, we just got an order for 10, 20, 80 megawatts. He said, forget that, it's gigawatts. I mean, he was describing the market as so huge. Can you actually build these batteries?
We will be building these batteries. And it's not just a question of we will be doing it. The next generation battery is one that will be coming out over the next couple of years. The introductory process sort of starts with us doing pilot projects sooner rather than later, sometime this year, and delivery next year. That product meeting the goals that we have for it means that a lot of projects that are currently looking at lithium and seeing extended times for delivery, et cetera, will switch. And that's what he was talking about, was saying once that product is out there, it will be so compelling that that's what will constrain the growth, is the ability to supply it. And we agree.
It was quite interesting, actually, because he's a major supplier of wind farms and that sort of thing. And actually, he was saying you can't even get hold of lithium batteries, whether they're the right price or not. He puts in an order and expects them to arrive in December, and it takes another 6 to 9 months where it actually turns up. So, I mean, I was quite surprised how critical he was of the lithium-ion battery for long-duration energy storage. And as he put it, it's just not fit for purpose. I mean, it was quite an eye-opening meeting. A little bit sensitive, I can't say who it is, but I mean, take my word, it was quite an opening meeting, and it did give me a vast amount of confidence. So, but I know you've got to jump to another meeting, and I've got to let Phil talk about all the sort of results we've had this week and that sort of stuff to work, because that's what the listeners love to hear. But Larry, just as a final sort of comment, I mean, it feels sometimes to the market that it's been a pretty tough, long journey to get where we are, which is understandable. Market people always want it tomorrow. Mm-hmm. It just isn't that simple, is it? And we've obviously had a few ups and downs or whatever to get here. Just tell us absolutely honestly. I'm going to look at your face, Larry, and check that it's honest. Look into your eyes. Are we at that big inflection point now where actually, you know what, Andrew? We've done all the hard work. We've gone over the hurdles. Now we're just about to get to the stage. Let's call it 2023. I don't mean today, January the 26th. 2023. Is this the year that we see this thing really take off?
I come over to London regularly, and for a long time there were boarded up walls somewhere, and then finally I saw stations for something called the Elizabeth line, but it wasn't operating, and it seemed to take a very long time. And then it opened up. We went on it today, and it's a beautiful, beautiful experience. Cost more, took longer than we expected, but it ended up because whoever built that didn't compromise on quality. We're the same way, and we have been making great progress, and 2023 is our year.
I certainly feel that way, and I think, again, wandering around town with the investors and potential new investors, it feels as though they think that way as well. So, Larry, look, I really appreciate you just jumping in for the first 10 minutes of this podcast. I know you've got another meeting to get to. I will just carry on talking with Phil, but really appreciate it. Thanks, Larry. And I've got a feeling we're going to be seeing more of you anyway this year.
Thank you for having me.
All right. See you, Larry.
Bye-bye.
Right, Phil, how about that? What do you think?
Well, there we go. That was Larry Zulch from Infinity Energy Systems, our client. And well, given the orders that they've been getting in and the momentum in their order bookings, it sounds like, yes, it could be their year where they finally get there into the markets. So they're seeing a lot more commercial interest. That's all good news.
Very good. Right, moving swiftly on. What do you want to talk about, Phil? You
Right,
kick off because
okay,
I've been
well,
pretty busy.
Yeah. No, there's been loads of trading updates out from companies. I mean, the first thing is investors will be looking out for is US GDP data. That's expected later on today, and it's looking out for signs of how is the economy likely to be doing, not necessarily well how it has been doing, but what's the outlook? Are we heading for a mild recession in the US? Will it be a rolling downturn? So let's see on that. And consumer spend is a big part of the US economy, and cars are big ticket items. And Tesla had its quarterly results, and they slightly beat expectations. Wall Street. This was the fourth quarter revenue. But they flagged some declining operating margins there. I mean, of course, we've had a lot of inflationary costs, especially in the automotive industry. And Tesla has been cutting prices, and it said that is seeing helping keep demand up and seeing growing demand. But what gets me about Tesla, and the share price has come right off on this, is that their forecast is for 1.8 million vehicles this year. But I not think, well, BMW are making what? I don't know, 2.5 million vehicles? That's how big Tesla has grown. So the share price has rocketed up, it's come back off. But it's got that strength now in the market. So may come down to a level where it's gets to be interesting again. So that's that. But more tech news in particular. Now we talked a lot about what's been happening in the computer industry, and this relates to PCs and servers in data centers and cloud services. And we've seen over the last 4 or 5 years a massive explosion in the use of cloud services in IT. And with big corporates outsourcing their IT, and it all goes into data centers rather than having it all in-house. And it's been a big driver for people like, particularly Microsoft, IBM, SAP, and we've been seeing announcements on job cuts. So I thought I'd just give a bit of perspective quickly on this. So Microsoft is, the biggest software company in the world. So PC operating systems, cloud services, ERP systems, and so they have their quarterly results, which are more or less in line with analyst expectations. $53 billion of turnover for a quarter. I wish we had a company like this in the UK to invest in. But the quarterly revenue was up just 2%, and they reported slowing cloud services demand, and they're expecting the coming quarter to be up 3%. Now, Microsoft, these job cuts are really interesting, Andrew. Quickly, it's just the scale of them. It's like they're cutting 5% of their workforce, and bearing in mind that it will have grown strongly already over the last few years, and it's 10,000 job cuts. But it's 5%. Not great, of course, for those people affected by this, but it's just giving a little bit of perspective, the proportion here. SAP have announced, SAP is one of the biggest providers of ERP software, 3,000 job cuts, and that's 2.5%. And they've reported 30% revenue increase in cloud services for fourth quarter. But of course, it's all about the potential outlook, and analysts a bit concerned. IBM have announced 3,900 job cuts, and that's 1.5%. So of course it's in proportion. Salesforce, which is CRM, 10% job cuts, but their roles have increased 60% in the last 3 years. So it's a bit of perspective, but we are watching the outlook on IT spend, cloud services. Quickly moving into semiconductor spend, silicon chips, again driven by the PC market. Computer markets are really important. Sales of chip making machines, equipment to make chips, are expected to fall this year, but ASML had its results. Seen very strong growth, and it's forecasting. It expects its net sales to grow 25% this year, but let's bear in mind ASML is one of the most important companies in the chip equipment market, global equipment market. So we will see, because a lot of the chip companies have been coming out with weaker results. Right, swiftly moving on to companies and trading updates. Little corporate
Actually,
about.
Phil, just before you
Go
do
on.
that, can I just make it one comment?
Yeah,
Obviously, we're talking about big tech there, and big tech has
Yeah.
really been suffering.
yeah,
But actually, I think that I've noticed over in the UK, funny enough, just reading all the trading statements, actually, little tech isn't having it as bad, is it?
no, not gonna. Yeah, no, it isn't. That's what it's all about perspective.
Yeah.
Yeah, that's right. Big tech's seen a fucking great boom, but we've got a number of companies that are exposed to quite specialist spaces where demand is continuing in tough conditions, in tougher conditions. Yeah, absolutely. Good point there, Andrew, and for our investors. And let's cover a few of these ones. So, I mean, quickly, this is a corporate of ours. It's Super C Capital, ticker's WWW. It's listed on Aquis last year, and they're a seed stage investor in B2B software and AI companies, and they specialize in SaaS companies. So it's early stage, and we're seeing a lot more money move into earlier stage investment because so much has gone into later stage companies, and they need supporting as the economy gets weaker. But this is identifying early stage, and they had a quarterly, just a quarterly update on the SaaS revenues that their company, their invested companies are generating, and they're still seeing high recurring revenues coming in. And this is because they've got very, very specialist technologies. And they saw recurring revenue up 21% in the fourth quarter of last year, and they've now, we only listed early last year. They've already made 9 investments. So really interesting little, it's a smaller side investment, but getting exposure to early stage tech. Now, on more mature technology, Andrew, we've had Oakley Capital.
Just going back to Super Seed,
Yeah,
sorry.
Hmm.
Because I did look at it, because actually, I must confess, I own some myself personally. But what I found interesting actually was also about, I think he was saying that, like, he expected the value of his portfolio to something like double over the next 12 months, didn't he?
Yes. Yeah. Yeah.
And
Yeah.
the other thing I would point out to it, we floated that just over a year ago at £1, and it's trading at about £1.10p. There aren't many IPOs from around there that actually are still at a premium. So, it is a really interesting little business. The problem it's got is, it was a very tough market at the time. We didn't really raise enough money. It sort of doesn't matter. If people wanted to get involved in this, I'm sure we could find a way, because we'd love to grow the size of the fund. It really is a superb little fund, though. Anyway, just make that point. If people are listening, Super Seed, come and talk to me. Back to you. Sorry.
Yeah. Oakley Capital market. This is big. Its market cap is 800 million. It's a closed-ended investment company, and they specialize investing in technology, consumer, and the education sectors. They just reported their full year results to 31st of December, and they have said that their NAV was 1.1 billion pounds, so 662p per share, and the shares are trading at 452p, so at a discount, and that the NAV per share return was up 24% over the year period, and always you look out for this in more mature funds. They made a good number of exits during that period. They exited to the tune of 234 million pounds with 5 exits, so a good overall performance during 22 on that. Now, yes, it's going to be an element of outlook going forward, but the exits that they made were on a 5 times gross money multiple. So that was in terms of uplift, and that's a reflection on their value add. So, I thought it was quite impressive. Getting on to individual companies, big technologies. Don't know if you've come across this one before, Andrew. Ticker is Big B, BIGB, 756 million market cap. And it's the parent company of Buddy. And this company was formed by the CEO, Sarah Murray, founded in 2005, and it's tracking technology. And of course, a big customer of theirs is the criminal justice sector with electronic monitoring. And they have reported results for their first financial half, which ends at the end of December, and they're expecting revenues of 50 million, up from 37.6, adjusted EBITDA of 30 million versus 20.6, results marginally ahead of current market expectations, has cash of 67.5 million, so that certainly gives them options. in what to do in developing the business. Only kind of thing is, it's not cheap, but then you do have to pay for quality, and it's EV revenue of 12 times from what I can find from Icon forecasts and a P of 31 times. So
yeah, that's quite expensive.
It's a little bit punchy, but high quality.
I was also worried for you were going to say that my wife had suddenly become a customer.
Right, Andrew, moving on swiftly. Spirent Communications was one of our former picks of the year a couple of years back. The ticker's SBT, 1.4 billion market cap. Spirent's a specialist in test equipment for 5G communications, Ethernet communications, wide area networks. So everything, all comms equipment needs testing before it actually goes and is plumbed into the networks. That's to meet its specifications. Full year results in line with expectations, they say, having navigated supply chain. Well, they are supplying hardware, so they've had all sorts of supply challenges and cost inflation, etc. Revenue grew by 5.5% to $607 million. Operating profit slightly ahead of consensus. However, now looking to the outlook, as previously communicated, economic conditions impacting some of their customers, resulting in delays of investment decisions. Not good. Heavier than usual weighting to the second half 2023. So that's been formed in terms of their revenues. Order books up 7%. But frankly, the market didn't like that, as you will see from the share price chart. So, the spend decisions on capital equipment getting delayed. So that's not overly encouraging. The smaller one, which did come out an interesting Interseed Group, IGP's ticker, 40 million market cap. This was a trading update. It's into cyber security software, and they are trading for the current year ending March 23. So it's a kind of outlook to March 23, really, and how they're tracking. Revenue of 11 million, EBITDA of 0.6, but they said that revenue now expected to be 5 to 8% ahead of market forecasts, and they're expecting to report results materially ahead with new business growth. That will be worth looking at, because in this market, for cyber software, for a smaller company to be performing that well, that merits a good look, I think. I suggest.
Yeah, I'll tell you one that's been amazing. Did you spot U Group?
No, missed it. Go on.
U Group. I mean, it's been amazing. I've talked to some of my clients about this for a few years now, because it got down to, I think, about 20p. A couple of years ago. It's now 694p. So it's been an incredible performer. I mean, it's a supplier of gas and electricity in the UK. So it's obviously gone ballistic. But their announcement said they had a trading update. Record-breaking organic revenues, profitability, and forward contract revenues have all exceeded management expectations. We are now in the fast lane of growth and expect to exceed current guidance that has already been upgraded in March, July, September, and November 2022. There's a stock that's gone flying, but probably flown enough now, is my guess.
Oh, well, sorry, it's YU, isn't it? U Group.
Yeah, YU Group. Yeah, been amazing. There you go.
There we are. Missed that one. But all right, quickly, just moving back on tech, learning technologies, LTG ticker, 957 million market cap. The guys here have built a big company. They've done a lot of acquisitions. It provides, they quote, learning and talent software and services to corporate customers. Well, as we know, that's short for training, a training software, and it's a global business. And they've said, they've set out publicly a goal, which can always be dangerous, but they've been confident here, saying they're aiming to achieve run rate revenue of £850 million, EBIT of 175 million by the end of 2025. Well, I ain't too far away. But they said that for the current annual period, they're expecting revenues slightly ahead of consensus expectations of 595 million versus 258 million last year. Remember, I said that they've been acquiring, so pro forma basis, it's 5% growth. adjusted EBIT not less than 100 million. And that's ahead of consensus as well. Now this, sorry, Andrew. Go on.
No, go on.
Yeah, I was just going to say quickly, this trades on 1.8 times EV revenue and 13 times PE and a PEG of 0.3. So
I think you're saying that's a buy.
Right, moving on. Yeah.
I'm going to give you one more because we're running out of time, Phil. You can pick your best last one.
My best last one. Okay. IDOX. IDOX, 283 million market cap. Full year to October end. This one trades on 4 times EV revenue, 23 times PE. Not entirely cheap. Shares have more than doubled in 3 years, but this one is very well held by institutions. And IDOX is software for, and then their software is used by the government. It's used in planning. So it's like in maintaining assets, is essentially tracking what assets are. But they sell quite a lot into public service space. They have engineering software as well for managing, I think, documentation and engineering specifications, all that kind of thing. Anyway, so the revenue was up 6% to 66 million. Recurring revenue up 12% 40, just EBITDA up 15% to 22.5 million. So I thought a reasonable set of results there for IDOC. So there you go.
Look, I'm sorry to cut you a bit short there, but look, if people think, hey, you didn't talk about the company I really wanted them to talk about, then just get in touch with us and we might give you a personal view on that company. But we're all running around. We're very busy. Actually, on the busy, just for what it's worth, there is no question of doubt that equity markets are a little bit more liquid at the moment, a little more activity, which is very good news. The market is taking the view that things are going to be a lot better in 23 than in 2022. And yep, things are going on. On that note, though, usual sort of stuff at the end. I won't do it because I'm in a bit of a rush. But you know what I mean. And we'll speak again. Well, we may speak again next week. I'm actually going to be in Johannesburg. But if we can find a time to record it, we'll do it, okay?
All right, fantastic.
Thanks, Phil.
Look forward to that. Cheers, Andrew.
See ya.